Way that we build a go-to-market roadmap is that we want our roadmap to be forward compatible. Something today that we build into the business is something that we would then want to build on top of as we go over time. What's the actual problem that we're solving for the customer, and where does that fit in terms of like the value for them?
A quick word from a tool that we use. Harmonic helps you spot the best startups before anyone else. We use it at GTM Fund, as do top investors at USV and Insight, and go-to-market teams at Notion and Brex. The platform tracks millions of startups and lets you search with simple filters or natural language. In seconds, you get founder backgrounds, traction, and market data all in one place. At GTM Fund, we even have a company watchlist Slack channel powered by Harmonic. Their website is harmonic.ai. Get 2 free sessions with their team to help you structure the perfect searches if you use the link in the show notes. Most startups obsess over building the perfect product roadmap, but few treat go-to-market with the same intentionality. Paul Williamson joined Plaid at $3 million in ARR and helped scale it to $300 million by building and evolving a go-to-market roadmap that served as the blueprint for growth. In this episode, Paul shares how he first built that roadmap, how it evolved through product market fit and upmarket expansion, and why every founder needs to treat go-to-market as intentionally as product. You'll learn how to sequence the right bets at each stage, avoid over-engineering too early, and use simple rituals to keep go-to-market aligned as you scale. All right, let's get into it. Paul, welcome to the podcast.
Thanks for having me, Sophie. I've really been looking forward to getting on.
It's a pleasure. Well, I want to get started because most founders obsess over a product roadmap. And one of the things that you advise startups around is to also obsess over a go-to-market roadmap. For everyone listening, can you explain what exactly a go-to-market roadmap is?
Yeah, absolutely. I first really kind of encountered or started thinking about this concept around about 8, 9 years ago when I joined Plaid in 2017. Since working at Plaid, I've been working with over a dozen different startups across a number of different spaces, and I've started to see a little bit of a trend in terms of the importance of building a go-to-market roadmap. So quite simply, similar to a product roadmap, a go-to-market roadmap is really sort of a documented and outlined structure about how a go-to-market leader, whether it's marketing, sales, customer success, or all of those functions combined, want to think about building out the structure to the go-to-market organization and really thinking about putting that information and that detail down on paper and kind of documenting and clearly outlining how we essentially want to go from where we are today to where we want to be in the future relative to the way that our go-to-market function ultimately works.
And what stage does it make sense to be starting this? Should founders be creating their go-to-market roadmap at the earliest stage? Should they wait till they've got their first pivotal go-to-market hire? What makes sense?
Yeah, look, I think, especially for founders, they're often going through sort of a founder-led sales motion in the very early days. I actually don't think that there's probably a lot of need for them to start to build, roadmap and things like that at that point. But especially as companies are starting to transition from a founder-led sales motion and kind of going into an actual go-to-market led sales motion, I think that that's a really, really important thing for companies to be doing. And particularly like the thing that I would encourage go-to-market leaders to think about is go-to-market really as a product. It's actually a key feature of the way that a company needs to operate. So treating it like a roadmap item within the business is a really important thing.
And how would iteration cycles function with a go-to-market roadmap? Very similarly to a product roadmap?
I think a lot of people talk about sprints and things like that from an engineering perspective, and a sprint might be 2 weeks or 4 weeks or 6 weeks or whatever that structure might be. In some cases, when you're doing early go-to-market work, you actually want to think about your kind of go-to-market roadmap in short incremental bursts from that standpoint. For example, when I first joined Plaid back in 2017, we had a very rudimentary sales organization at that point. And we really thought about version 0.1 of our go-to-market when I first arrived. And we really thought about iterating on that go-to-market structure consistently over the course of the year. In the first 12 months that I was there, we probably went through nine to 10 different sort of subversions of what go to market and our go to market motion would look like. Because our business at that point in time necessitated the need to kind of rapidly change and rapidly evolve the way that we essentially approach go to market. Now, over time, as a business continues to kind of scale, as a business continues to mature, you might not be doing it with that same level of maybe monthly cadence in terms of the change or update. And the window between essentially version changes of your business will probably start to get longer as the business kind of gets more scalable, more consistent, more repeatable, which is a good thing, right? Like we want to see a business continue to kind of find structure. We wanted the business to find patterns inside the organization. But what we really want to be thinking about, and one of the things that I talk a lot with founders about, is that the way that we build a go-to-market roadmap is that we want our roadmap to be forward compatible. Something today that we build into the business is something that we would then want to build on top of as we go over time. You know, a lot of people from a technical standpoint kind of talk about when product is built, it's backwards compatible. Does the thing that we're building now work with the things that we've already built? And you could probably apply that concept, but I prefer to kind of talk about it as like we're going to continue to kind of build on the foundation that we've got. And each iterative version should be an enhancement or an improvement on the thing that we've done before.
Okay, so you use this go-to-market framework at Plaid, and clearly it works. You headed up revenue there, took it from 3 million to 300 million. Let's break down how you actually applied that roadmap. You've mentioned a few things now. So you join at 3 million. What was the state of go-to-market, and how did you actually outline that roadmap?
When I joined Plaid, as you mentioned, we were doing about 3 million in ARR at the time. We had approximately about 100 clients who were working with us at that point in time. And by the way, we had some amazing clients in those early days: Venmo, Robinhood, Acorns, like household names now from a fintech perspective. But when I walked in the door, we had two things that we were really fortunate about, is that we built a product that was really valuable for people. That was part one. And part two is we actually had a fairly good amount of inbound that was coming into our business today because we were solving a pretty important problem that hadn't really been solved that well before. However, to call our our go-to-market motion in those early days sophisticated would be a massive overstatement. When I first turned up and we had a couple of founding employees working in go-to-market at that point in time, for example, our qualification process was really rudimentary. We asked four questions, and it feels laughable to talk about these four questions now. But the four questions that we asked were: have you downloaded our API keys? Have you read our technical documentation? Where are you at in terms of your build out of your application? And the fourth part was like, when do you expect to go live? That was qualification for us in the early days. And obviously, most people would probably laugh at that level of qualification. And, you know, looking back, we do as well. But the thing is, that was what felt was the right approach for us at the time. But what we weren't like really seeing, what we weren't starting to understand is what's the actual problem that we're solving for the customer, and where does that fit in terms of the value for them from that perspective. And I'll talk about one like, big thing. As I said, we used to have a lot of inbound, like often like hundreds of inbounds on a weekly basis were coming into us. That was because we built some strategic referral partnerships in the early days with people like Stripe and Dwala. And so we had quite an effective top of funnel flow coming into the business. But the thing about that is that of the 100 leads that we were getting a week, a lot of those leads were not equal. However, our behavior in terms of the way that we were working with those prospective clients, we were treating all of those opportunities as equal. And so, you know, what we were looking for in the early days is to starting to recognize patterns in the business, good patterns for us, and then the anti-patterns. Like, what are the things that we don't see a lot of value in? And the example for us in those early days is of the 100 leads that were coming in a week, 90 of those were kind of like payment partner referrals, as I mentioned, like with Stripe and Dwala. And what was happening in that instance is that those prospective customers were thinking about ACH, so bank to bank money movement, as a additive feature to their payment stack at that time. I.e., hey, we already take credit card and all these other things, of which credit card might have represented 95% of the money movement volume that they needed for their business. And then ACH was this small fractional component of what it is that mattered to their business. And so what we recognize is like that's an anti-pattern. Like that wasn't a good pattern for us to go invest significant time, energy, and effort into. So we had to ask ourselves a question of like, do we want to spend time on that opportunity on a client like that? In fact, the answer for us was that this is actually a much better client to actually reroute back to a PLG motion because that was actually going to be the most effective strategy for us, both in terms of how our product worked and operated, but also that was the most cost-effective way for us to acquire those customers. And what we needed to get to a quicker understanding of is, hey, there was probably about 10 really important prospective clients that were coming through for us in those early days that wanted us. ACH was the core funding reason for them to be using Plaid. And they wanted to do other more enriched services, validate the person's identity on the other side, maybe understand things like how much money they had in their account so that they wouldn't have an NSF or an overdraft if they were doing things like funding their Venmo account or funding a trading account like Robinhood and things like that. And so again, it was one of those things where we could have become very enamored with the 100 leads that were coming in every week and try to treat everyone equally. But what we quickly realized is like we couldn't and we shouldn't be treating everyone equally because our prospective clients were not equal in terms of the value that they would receive from the platform from us and also the value that we could then invest back into working with those early prospective customers.
How did you think about evaluating that value?
Yeah, I'd love to tell you that we were that sophisticated in the early days. Honestly, for the first, I think, 3 to 4 months that I was in the business, we essentially did a morning stand up and an afternoon stand up. And particularly as we started to add more people into the business, it became even more important for us. And so, really, what we were doing in the early days is that we were manually looking for patterns inside the business and what worked or
Okay.
what wouldn't work. And what we started to see quite clearly early on was like there was a clear delineation between these high value, high impact clients and like low value, the customers who thought that what Plaid could do was accretive to their business, but not essentially the core to what it is that they wanted to do inside their business. And it was great. Like we actually would get to the end of the day and literally we would talk through nearly every single deal that we'd gone through a qualification process on. And particularly because we were also making real time changes to the way that we were doing qualification, it was also a
Right.
good check-in point for us to say, okay, cool. Hey, this like V0.1 of our qualification process, is it working? What would we change? Like, why would we change it? Is there an extra question that we should add tomorrow? Is there a different way that we'd phrase the way that we would like ask that question tomorrow? And then we'd also then recount like who had what calls. What did they do? What did we find out on those calls during the course of the day? That was really a great way for us to recognize that. Again, we weren't that sophisticated of product feedback loops and all that kind of stuff because, again, we were still really early in terms of our process. And I know that by the team was probably quite sick of me like running a daily stand up twice a day for the first 3 or 4 months, but it was also an amazing way for me to learn the business, but also for the team to start to recognize as well what were good prospective clients and what were less good prospective clients. We all obviously wanted everyone to be building on Plaid, but there were just prospects that we knew that we should be spending more time with than less. And effectively, we shouldn't be treating everyone equally because of the value that represented to us and also the value that we represented to them as well.
Makes sense. And this is around 2017, you mentioned. You're running
Yep.
these stand-ups 2 times a day. How many people are in the company overall in these
So
early days?
Plaid, yeah, Plaid was about 50 people in those early
Okay.
days total, by the way. So like that was go to market,
Engineers. Okay.
engineers, all that kind of stuff. Exactly. And for me on the go to market side, we had two initial kind of founding AEs in the business, and we had two people on the account management customer success side at that point. And then we started to add a couple of people to the team. Particularly, we added two SDRs pretty much almost immediately to really become an initial filter for us for those kind of 100 new prospects that were coming in, because it was really a good opportunity for us to start to then route where that prospective customer should go. Is that something that should be sales led? Is that something that should be product led? And being really prescriptive ultimately in steering where a prospect should go. Because like there were also, like, in some cases, we couldn't do as good a job as what the product could potentially do for a certain segment of customer. But there are also places where we, as a sales-led motion or a go-to-market-led motion, we could do an inordinately better job than what the product could do from that standpoint. And so we kind of like wanted to, it was human-based routing at that point. We didn't have this amazing level of sophistication, at least at this point in time,
Yeah.
which sounds like quite rudimentary, right, compared to where people are today in terms of revenue operations and revenue engineering. But it was the right thing for us to do at the time. And it got us really, really close to the business. It got us really close to the use cases. And it helped us get really close to the customer and where the value was for the business.
Did you have a go-to-market plan, a roadmap outlined at this point, or was it going through this motion where it created the inspiration for writing a go-to-market roadmap?
Yeah, so I think one of the things that I learned, especially early on in terms of my work with like the two co-founders of Plaid, Zach and William, is that, and look, this is not just a Plaid specific thing, this is a nearly every early stage tech startup thing, is that VCs invest in highly technical founders who are going to build technical products, right? Which is fantastic. Like, really, really smart people have found a way to technically solve a quite a unique problem. And the thesis of VC, right, is like, let's go invest in those people. And it's a great thesis. And I'm not saying that that thesis is bad, but obviously, in more often than not, those founders that get invested into often have very little understanding about go to market. The reason why this kind of concept of a roadmap became important is because I also needed to take Zach and William and subsequently other founders after this through the process. Like, they actually did want to know about what it is that we were building. Why were we building these things? But it actually made it a lot easier for me to ultimately communicate what was our plan, why it was important, and what we needed to build next. And really, essentially, in the early days, we were making that plan on a near month by month basis. Hey, we just implemented this new qualification framework. We're seeing really positive signal about it. Okay, the next thing that we're actually going to go build around us is a little bit more sophistication in terms of how we price. Like, now that we've gotten better at qualifying our prospective customers, we understand the value that we're creating for them. Cool, we probably need to get a little bit better about how we price, how we write a proposal for someone, because we also wanted to really make sure that we were tying what it is that we did to the value that was being created at those companies as well. And it meant that we just would kind of continue to build into the sophistication over time. And again, like I said, in the early days, we were literally going month by month. We would like get towards the end of the month, and I was like mini brief about what the roadmap would look like for the next month, and
Yeah.
month over month in that first year. And then in our second year, it was really like, hey, every other month we would be kind of talking about like what was going to come up on the roadmap next. And by our third year, it was like kind of like a quarterly roadmap. Fourth year, it was a half yearly. Fifth year, it was kind of half yearly as well. Sixth year, we were already thinking about what the roadmap looked over a 12-month time period, because obviously go to market had continued to get larger over that time. As I said, we were founded and we had about 4 people when I started. By the end, it was close to 200 in the go-to-market organization. And so it's very hard to be operationally changing things month over month with that many people. Like, the
Yeah.
impact that that would have on the business is actually probably quite negative, the speed of change at that point. But it really resonated, and it was really important for us in those early days to have a real rapidity of change. And the great thing is, by also documenting these things, it kind of kept me a little bit in check too, of like, hey, am I investing in and putting the effort into the right things at this point in time? I think most go-to-market leaders, when they start inside an early stage business, and I hear this from former colleagues who've all entered into kind of like going from like large tech and into early stage startup, there's often this like paralysis because there's just so many things that could potentially be done in a period of time. And it actually gave me real clarity of thought about being focused on what was important at that moment for us as a business. It wasn't about taking the playbook that I knew and superimposing that into the business that I was in. the playbooks that I've known and learned and had an appreciation for over the course of my career are really just it's just information that I've got, and I need to work out whether the things that I've learned and experienced before are applicable to the situation that I'm in today. It's not about taking the thing that I was at and dumping that on top of the business, because I think overly building process in the early days of companies is nearly as risky as no process. And there's that really healthy balance that you need to have. And I think go-to-market leadership probably feel this most acutely out of anyone, is like really making sure like that we're building appropriately for the stage of company that we're at, and we're not overbuilding. In fact, you probably want to feel like you're just always a little bit behind in terms of like your go-to-market structure relative to the rest of the company, rather than too far ahead. I think if you're too far ahead in terms of the infrastructure that you've built into the business, then you've probably overbuilt and overstructured the organization, and you're probably running a cost inefficient go-to-market organization, but you're probably also imposing way too much structure inside the business that will actually be a net negative for the business, not a net positive.
Mhm. So it sounds like go in parallel to the rest of the company in terms of finding that happy medium of
Yeah,
sophistication
a
of
super, super
process.
healthy balance.
Yeah. And so to super tactical question, but to not create overly process areas as you build this out, how are you actually communicating this to the team, to founders? If someone were to listen to this and say, I'm going to create a go-to-market roadmap, what would you recommend they do for actually sharing that and disseminating the information?
Hey, look, I think today anything like a GDoc all the way through to kind of Notion or something, so something that is, by the way, completely accessible to everyone inside the organization is the best start. And we shouldn't hold these things private, right? We should be actually getting these out and exposed to the team, because I think it's a really valuable exercise, not only for a go-to-market leader to document it, but also have it be presentable. Because I think once you start to talk with people and you start to articulate what it is that you're building, and you start sharing, and you're also willing to actually receive feedback on this stuff, it will also make you a way better leader in the process. And I think one of the great things about that, by documenting it and like publicly sharing this stuff as well, is that you then start to take the rest of the company along with you in that journey. And this, I think, was very, very impactful for us at Plaid. And again, I've seen this in terms of the dozen plus organizations that I've spent time with advising over the last few years, is that then the rest of the company also gets really, really bought into the investments that you're making and why. And they become, quite honestly, a much better partner for you in that process, because they can see what it is that you're building. And it's not this black box of go to market stuff. In fact, I think that's what a lot of early stage founders fear when they bring their first external go to market hire into the business is, this person's joining from X company. They're going to come in, they're going to impose their will on our organization. We're more engineering focused, or we're more product focused in the things that we do. And I think by being really transparent with the things that you're building, being really clear and making it accessible to anyone who's interested in finding that out, I think that's a really great place to start. But again, particularly, I think the key there is get it documented, start sharing, and really see this as an incremental improvement. I'm a really big believer in making today just a little bit better than we did yesterday. That's the way that we should treat this kind of concept of a go-to-market roadmap as well. How are we improving today over the things that we did yesterday, and making small incremental improvements and changes progressively over many, many years inside an organization?
I bet if you ask anyone within an organization, they know the product roadmap, they know what's coming. It sounds like it should be the exact same on the go-to-market side. If you ask anyone, whether they're on the technical side, go-to-market side, everyone should have a clear idea of what that roadmap is.
Yeah, completely agree. Because I think one of the things sales teams and go-to-market teams always clamor for is the product roadmap. We need it because we need it to sell and we need it to do these things. But then conversely, if the go-to-market organization is doing things that people don't have any context of, they don't have an understanding of, an appreciation of, then they won't be able to be as involved or positively impacted by that. And the thing that we found at Plaid particularly is, as we started to share this more with people, the head of engineering, Jean Denis, and I would spend even more time together kind of aligning how product releases and updates would be coming out, and where does that fit now in terms of our roadmap. So we really saw this as a very unifying function for us inside the business. And in a lot of cases, I think it was one of the reasons, not the only reason, but one of the reasons why we were not only able to accelerate the growth the way that we did, but it got us to a much, much faster, much better operating place and a much better operating cadence as an organization.
That is fantastic. And you had the first stage at Plaid where you were iterating, you were having these stand-ups twice a day. What came after that as you started to move away from all the inbounds and really double down on the high quality prospective accounts?
One of the things that became important for us as we started to recognize who the most high value clients for us were, then the question then became, what do we need to do to seek out more of those really high value clients for us? And so then we started to think a lot more about what is our acquisition strategy? What is our distribution strategy for us inside the business? We had a very positive impact from some early product partnerships that I mentioned. But what we needed to start thinking about is, okay, cool, like we need to start to diversify our top of funnel. And what does that look like, right? Like, what are the other channels for us from an acquisition standpoint? Should we do more things from a partnership perspective? And this was, by the way, for us in the early days, it was partnership referral, not partnership selling. We got to partnership selling much, much later in the journey for us at Plaid. But we really then started to think about what do we need to do to go start generating better high quality top of funnel. Let's get more committed to field marketing. Let's commit more in terms of kind of like our like SEO. Like, let's start to get into things like paid. Let's start to get into things like outbound. And so we really wanted to then go to start to diversify the things that we did from a top of funnel activity for us. And that was a really critical thing. But it was only once we kind of like could see really clear, repeatable patterns for us in the business that it then made sense for us to go and invest into these other channels, because that we knew that if we put $1 in the top of the funnel from that standpoint, then the likelihood that it would precipitate into revenue for us was pretty high. We were moving out of this kind of like very random but amazing stage for the business and just bringing in more structure, creating more repeatability inside the business. And once you see that repeatability, like that's a really, really good sign for us to then start to invest in scale.
Incredible. As you scaled and started to create that repeatability top of funnel, would you say that accelerated your focus on a different type of customer than all your inbounds? So it sounds like you shifted all your inbounds to more of a PLG motion. You're building out more of that sales-led motion, including the 2 BDRs you hired.
Yeah, exactly. So, we went through a series of really interesting stages in terms of kind of Plaid's go-to-market motion and our areas of focus of the business. In the very early days, we were a fintech ourselves, working with other fintechs. And look, that was a very fast-growing, rapidly expanding part of the market. There were literally hundreds of new fintech applications being built every year, and people starting to bring in inside these fintechs like the kind of data that Plaid could provide to really deliver on a unique product experience. But what we also thought about over time is like, obviously, like fintechs will not be the only customer for us here at Plaid. And what does like the next phase of growth look like for us as a company? And we had sort of like two major customer categories that we kind of thought about after the early stage fintech. The first of that was kind of like going up market in fintech or financial services. That was to go into like the more traditional banks and wealth organizations and things like that. So starting to work with large financial institutions as customers. The large financial institutions were a big part of the data network that we were providing, but there was also real value in what we could actually provide the traditional financial services businesses as well, because they had massive businesses around savings and account opening and funding to loan originations, like whether it was unsecured or secured mortgages and home equity lines of credit. So we really wanted to start to move up market. But in that sense, what we also knew is that the likelihood of those traditional financial institutions coming inbound to us were very, very low. But we really then understood what our value proposition was. We knew who we needed to go to market with, and we knew who we needed to target. And so we got really, really clear about who they were from a prospective standpoint. And we started to get more focused on outbound field marketing and other things like that to really go drive ourselves into that audience. And so that was phase two for us as a company, which was really exciting. It's a very, very slow process, at least at that time, selling into like the large enterprise banks and financial institutions. But it was one that we kind of committed to about 2 years after I started, late 2018, kind of getting into early 2019 was when we really started to kind of focus on that because not only was it important for us to start to diversify, we also had a product that was ready to sell into that market and into that space. Because the largest of enterprises, especially financial institutions and wealth and things like that, they had very specific needs from us as a company. They wanted uptime and availability. They wanted service level agreements. They wanted a lot more enterprise reporting and insights. They wanted things like SSO and rules-based access control and all these other things that in the early days of us when we were working with a fintech, those things didn't really matter, to be perfectly honest. So we needed to not only evolve and change the way that we did our go-to-market, our product also actually needed to evolve. And this was the other big thing about having a roadmap relative to our go-to-market motion. I could then talk about our roadmap and say, look, we are now going to start to focus about going up market, and we're going to need these things to become a reality of our product for us to be successful. And so then it became a bi-directional conversation between go-to-market and engineering about what we needed from a product perspective. And then the third market for us that we went after is we went from fintech, as I said, into traditional financial institutions. We then went into what we would call this embedded fintech stage, which were companies that weren't fintechs and companies that weren't financial institutions, but they wanted to bring in a financial element into the product that they were offering. And a really amazing example there are like the major telecommunications companies. They wanted to actually stop taking things like credit card payments. They wanted to move from credit card into ACH and make a fundamental shift, by the way, in terms of the way that they got paid by their consumers. Or another really great example for us in that instance was Tesla was an early client on the embedded fintech side. And so what was really interesting about them is they are building like one of the most modern vehicles in the world, but your down payment and things like that for your Tesla was by check. So this is like the most modern vehicle in history today, but they were using a payment instrument from the 1700s. So it was a really funny kind of like brand dissonance that was happening there. And so we had companies that wanted to make the financial element and elements of their product be more akin to the way that like their modern tech, their modern stack, their modern products were there. And that was really like the next phase of growth for us as we truly moved out of just purely servicing fintechs and financial institutions, but moving into this kind of like concept of embedded fintech.
What kind of ARR inflection were you at where it made sense to go into this phase three, this embedded tech?
We were scaling pretty rapidly at that point. So we were probably around about the 100 to 150 million in ARR, where that became quite important for us. Obviously,
Mhm.
we'd grown very, very rapidly with our fintechs and also with traditional financial institutions at that point. But that was when it became a really important part. And that has become one of the core things of the business today for Plaid, which is really exciting.
Super exciting. And what were some of the biggest challenges that you faced? Obviously, a lot went right in their journey scaling 3 million to 300. What were some of the biggest challenges throughout that?
Oh, we got probably just as many things wrong as we did. People talk a lot about the compensation plan, the compensation structure for their teams. But one of the things to really think about when you're building the right kind of compensation structure is also the impact that it actually has on the way that your teams sell to your customers as well. We made a really big mistake in the early days, particularly as we were moving into like our enterprise business. We had a commission and payout model that worked really well for high rapid, high growth, short sales cycle SMB clients. Often, people were signing a 20K, 50K, 80K order form, but they were happening pretty rapidly. Like we were closing deals in same day to less than like 45 days. And we had a great compensation plan that really worked and was quite reflective and representative of our SMB business that we were. But as we started to move into the upper market, Our compensation plan really then said, hey, the way that you would be compensated is essentially on the initial structure of the deal. What it actually meant was that our sales teams were actually keeping a deal open for a lot longer period of time than what we would have liked. So what did we do? We had incentivized in terms of our structure for the team to keep a deal open for longer. So that meant that a deal was essentially quote unquote on the street for a lot longer than it needed to be, because the way that our compensation structure reflected that was like, hey, we would pay you out on the initial structure of the deal. So what
Right.
it did is like our AEs were actively delaying and trying to find not just the first use case, but the second and the third and the fourth use case to make that initial deal as big as possible, because that's what our compensation plan was incentivizing them to do. That was such a fundamental mistake for us because it actually meant that our deals were staying out there a lot longer than we would have expected because people were trying to supersize these things. And so what it did is that it just created way more surface area for us to make a mistake in the sales cycle. It often meant that our competitors would actually become involved in the sales cycle. So we actually created more competition for ourselves in that process. And we essentially were just creating more risk in terms of getting deals done. And so that for me is probably one of the standout mistakes that I made, along with like hundreds of other mistakes that we made over the course of the 6 years that I was there. But that was probably one of the biggest ones. And we needed to go make that change. And once we recognized that that problem existed, we made a wholesale change to the way that our compensation structure worked. In fact, we ran different compensation structures based on the different roles that we had inside the business because that's what the business warranted. We couldn't build a structure that was just one size fits all.
And that's great advice for anyone really building out their teams too, is to think about whether a blanket process makes sense, whether it makes sense to build them in silos a little bit more.
The key there is like really don't over engineer the process. For us, when we were thinking about kind of like our go to market motion, we really wanted to keep things simple. And I think that that's a really important thing, especially in a rapidly changing, rapidly evolving environment. And I think that would probably apply not just for Plaid, but like many, many high growth startups that are out there today.
Great advice. And Paul, are there any books that have made the biggest impact on your career?
Yes, I mentioned before thinking about improving the business, like making today just a little bit better than we did yesterday. I've always talked about this concept for a really long period of time. And it wasn't until I read this book, and I read it a couple of years ago. It was this book by James Clear called Atomic Habits. So essentially, like, how do you go build repeatable habits inside the business? It really, really resonated with me. I think I had sort of like articulated versions of that kind of concept for a really long period of time, but it really, really hit home for me personally. In fact, we actually got James to come to our revenue kickoff in 2021, I think it was, or yeah, 2021 or 2022. And really spent
Incredible.
time with the entirety of the Plaid team, and that for me was really impactful. And I'll give you a second one, A, because I was a contributor to this book, but B, I think it's a fantastic one. So Index Ventures actually is a fantastic VC, but they're also a fantastic publisher. And they actually wrote a book a couple of years ago and released it, and it was called Scaling Through Chaos. And I think it's a really important book for not only founders to read. It's largely directed at founders, but I think it's also really important for go-to-market people to read this, largely because it will help get you into the mind of what it is like to work with a founder, some of the pressures and the challenges and the issues that they face daily, and kind of like where our role as go-to-market leadership should fit relative to founders. So I think that that's an important kind of like industry read for anyone.
Great recommendations there. We'll drop them in the show notes, and both fantastic reads. I think the James Clear one I actually got notes of earlier in your conversation around just focusing on being 1% better every day and that incrementality mindset. Well, Paul, this has been fantastic. Really appreciate the time. Appreciate you sharing all of these insights and your journey at Plaid. Where can people find you if they want to get in touch or follow your journey?
Best place to find me is on LinkedIn.
Brilliant. That will also be in the show notes. Paul, thank you so much to all our listeners. Thank you for joining us, and we will see you next week.
Thanks, Sophie.